Trey, welcome back. It's good to have you back in here. We've got Trey today with Nesbitt Agencies in to talk about anything and everything HOA insurance. That's been a hot commodity, a hot topic for a long time. I think it always will be. Last time we had you in, the market was different. Tell us what's changed in the last, 12, 18 months?
Yeah,
Everyone was kind of freaking out. Huge, massive insurance premium increases. What's new?
Yeah, so first of all, thanks for having me back. It's always a pleasure. Really enjoy just having these good, casual, open discussions about important topics. And insurance, obviously, in the HOA space is critically important right now, and it's, I think, top of mind for everyone. So last time I was in, we filmed a really, really good, nuanced conversation about the state of the market about a year ago. And things have definitely shifted a lot since then. I would argue for the better. So just kind of historically, speaking, over the past 5 years, nationwide, we've been in what's considered a hard market. So demand has outweighed supply, basically. And insurance has been tough to come by, particularly for community associations, multifamily being the hardest hit, condos and townhomes. Rates have been spiking, 100, 200, even 300% in some cases, which is just absolutely wild. However, with that, there was some serious short-term pain, but we are starting to see some softening in the market, which is really, really encouraging for me to see. So the ice is starting to thaw a little bit. There are some more carriers showing interest once again. And most encouragingly, I think of all for probably your clients and my clients, is that we're starting to see some rate relief. So we're starting to see premiums, hold more stable instead of seeing, 40, 50, 60% increases, and in some cases much more. We're starting to see 10 to 15 to 20% increases. In some cases, this won't be the case for everyone. We're actually starting to see decreases, which is fantastic to see. Now, I always like to say, don't take that, and run with that statement, because it's not going to happen overnight for everybody. But some of those associations that were hit with a really outsized increase, like the 100, 200% increase that I mentioned off the beginning, we have started to see those rates ride down a bit. So we are looking at premium decreases, specifically for some of our larger clients who are hit disproportionately hard by the market collapse.
It's got to be really important for communities that are doing their budget right now. The last 2 years have been budgeting, kind of throwing a dart at the dartboard, saying, I don't really know what to budget for insurance increase. It's going to be 50%, it's going to be 30%. Well, whatever the difference is on that is a huge deal for a lot of communities. So are you saying, you don't have the crystal ball, but are you saying that to budget for insurance, let's say you renew mid-year, like in a June or July or something, is it safe to, instead of budget a 50% increase, to budget a 25% increase?
Yeah, so I'll put the caveat of, it depends on your circumstances. Have you had claims? What is your individual picture look like? So that can obviously impact it. But yeah, I would say so. I'm just getting real world example. We're in budget season right now. I'm getting a lot of requests from clients and property managers saying, hey, what can we expect to see? I've been typically going back to most of them, with some outliers, saying that, hey, I think realistically budget 20%, and we very well may come in flat. With a flat renewal,
which is way different than the last.
Which is way different. Our last conversation was all doom and gloom. Saying that we don't see an end in sight, and at the time we didn't. But what has happened is the carriers, through those rate increases and through increased deductibles and less favorable coverage terms, have been able to recoup their loss ratios. Like, they were running a 200% loss ratio in some states, and some states even higher than that, for years on end. That's not sustainable. If you're spending more money than you're making, basic economics says you're not going to play that game. So that has shifted. Carriers are once again profitable, and we're gaining profitability all the time. So I can confidently say that, unless something drastic happens, I do think the worst is behind us. Now, a lot of lessons have been learned by the carriers, and I think this is important too. So while rates might be stabilizing, I do think, I know some of the more stringent coverage terms, higher deductibles, those are here to stay. I don't see that changing. And I can make a pretty good argument that's probably for the better. Carriers have learned that in order to remain in the market and remain solvent, that they're going to have to put a little more onus on the clients a little bit, and that's through deductibles, through certain exclusions that might not be as desirable as they may have been 10 years ago, which can be frustrating, but the alternative is not being able to secure insurance. So, and if you can secure insurance, do so at a rate that we were seeing a couple years ago, which was 300% higher than it had been. So, while rates are stabilizing, I do think some of the stricter underwriting and more disciplined underwriting and coverage terms are here to stay.
Do you see things stabilizing? Like, is it geographic or is it kind of everywhere? Like, is the Midwest different than the East Coast or vice versa?
Yeah, there are obviously outliers like the Southeast, where I'm based out of and live. They, hurricanes are obviously the number one driver down there. The West Coast, it's wildfires. The Western, not just the West Coast, but the Western half of the U.S. So there are some outliers there, but in general, the national market is seeing a softening trend. So, and that's not just for associations. That's for, you're talking large commercial property as well. So the national market is, in general, moving in the right direction.
What a huge relief to board members and homeowners, because I feel like board members just put their hands up when they would budget or they'd get an increase, and it was, like you said, doom and gloom. How many times you have to deliver bad news in the last 12 months?
Yeah, all the time. I got way too good at it.
Yeah. So, that's excellent news for people that are putting together their budget, especially those that are a mid-year renewal, when you're kind of rolling the dice on the second half of your budgeted, fiscal year, and you don't know what's going to happen. It's nice to know that probably what you're saying is most of those, as a general rule, don't have to go into a panic mode of, we need to increase our budget. I just had a meeting last week or 2 weeks ago with one that, what are we going to do for insurance? Budget 50% increase?
Yeah.
I have no idea.
Yeah.
So to take that and knock that down from a 50% to even a 15% increase makes a huge difference.
Huge.
To really any community, but especially, your small to mid-sized type of association.
I think you nailed it. It's not just the fact that rates are stabilizing. It's the fact that you can budget and plan. It's one thing if rates are going up, at least you can plan for it. But, if is it going to be a 40%, a 60, an 80% increase? I don't know. There's a big difference between a 40 and an 80% increase, so the fact that boards can actually, with some degree of confidence, plan a little bit better now, just from an operations standpoint, I think is huge.
Are the carriers doing the same thing where some of them are still requiring payment in full at the beginning?
Yeah.
Because I've had people that have to liquidate CDs just to pay their insurance premium for 1 year.
Yeah. So typically when payment is required in full, that's going to be through what we call a surplus lines carrier. It's the alternative market to your standard carrier, which surplus lines carriers, they kind of get a bad rap as the option of last resort, but frankly, they're the only thing that kept the market afloat over the past few years. So they served a really, really important role, and they still continue to. But yeah, those are the carriers that typically require payment in full. Now, there is third-party premium financing available. Those rates are typically pretty high. So payment in full is obviously preferable. But with that, there are some standard carriers that are dipping their toe back in. So I've actually gained access to a few really competitive standard carriers recently who are chasing after multifamily and not just the brand new stuff. They're looking at older properties too, which is huge because we haven't seen that in years. And those particular carriers, standard carriers, generally offer no interest financing. So you can break it up into pay monthly or whatever it may be with no third party interest fee.
So there is light at the end of the tunnel.
For those that are listening. Yes, there is. So no more, creative accounting trying to pull from reserves and special assess. Hopefully those days, if not over, they will be soon.
Trey, if you were a board president, at a community and have experienced what many HOAs around the country have experienced over the last 6 months to a year, what would be your mindset, whether it be from a cash perspective or just related to insurance?
Mm-hmm.
Can you kind of share what that would be like from your perspective?
Yeah. So obviously my head goes right to the risk management side of things. So obviously from a cash flow perspective, and we covered that, but really there is going to be at least some degree of certainty, more certainty than we've seen in the past as far as being able to budget properly. And there is absolutely light at the end of the tunnel in terms of rates for most associations. Now, again, if you just had a major fire or a major hailstorm, that might follow you for a couple of years. But for the most part, I think there is reason to be optimistic. The other thing I wanted to touch on was the importance of really diligent risk management. So underwriters, like I mentioned, they're going to be more disciplined, as they have been over the past couple of years during the hard market. Though that's not going to change, because carriers don't want to find themselves in the situation that they just were again. So what does that mean? It means really implementing pretty rigorous rules regarding risk management. Now, a lot of carriers, the one everyone likes to talk about is grills on decks. That's been huge, particularly for townhomes and condos. Get that question a lot. It is wildly inconvenient. I completely understand that. However, the vast majority of carriers nationwide now are simply saying you cannot have a gas grill on a deck or a balcony or within 10 feet of the building. So we're seeing that a lot. So as unpopular as those kind of rules might be, those are things that are absolutely going to work in your favor when it comes to securing favorable rates and favorable coverage. That might mean things as small as really enforcing and implementing salting walkways, things like that. That is actually a huge driver for claims. And carriers all the time ask me, do they have some kind of regular salt and snow removal contract in place, or what do their policies look like on that? The biggest single thing, without doubt, is going to be preventative maintenance. That's the biggie is obviously the roof. Roofs aren't getting any younger, and that is the number one driver in most states for claims. It's going to be hail or wind. So the biggest thing is, I would say, keep your reserve study current. And I know you guys are obviously big proponents of that, and I could not agree more. So keep your reserve study current. If I can go to an underwriter and hand them a reserve study that was done, 12 or 24 months ago, that is gold to me. That is going to tell them one thing. It's going to tell them that, they're on top of it. They're actually having these things done on a regular basis like they should be. There was responsible community. More so, it's going to give them, the book on exactly what this property looks like, exactly what condition it's in. So have a reserve study done. And if things are outdated or becoming outdated, address them sooner than later. If I can go to a carrier and say, this building that was built in 1972, they have aluminum wiring, which is another hot topic. If they have aluminum wiring, but it's been remediated with one of the approved methods, that's a totally different conversation than having than basically coming to an underwriter and saying, hey, they have unremediated aluminum in here. That's going to be a non-starter for every carrier. So being proactive with that, it's on a very basic level, it's beneficial to the community as it is. You're protecting your community, but from an insurance perspective, I would tell boards, be very disciplined in that and document. If I can show an underwriter something, a piece of paper that says this was done, or an invoice says this was completed, that's going to work wonders. That's going to give me all kinds of leverage.
So as a reminder to board members and homeowners, obviously you have your governing documents of your articles of incorporation, your declarations and bylaws. Your declarations in particular should highlight the insurance that they should cover in their community. But what you were referencing earlier was adding verbiage to what is rules and regulations. And amongst our clients, not every single one has rules. Some of them don't realize that document can be created. What we recommend is that they potentially get an attorney involved to kind of advise them as they draft rules and regulations. And so although those governing documents were created by an attorney when the community was originally built, the rules and regulations can be created by the board. However, they need to be enforceable based on what the governing documents share, right? So what you're saying is, if rules and regulations potentially don't exist for a community, have them created.
Absolutely.
Right? Make sure that they're enforceable. An attorney oversight will kind of help accomplish that. But more importantly, that you're putting in verbiage in there that communicates to the community strict guidelines that have direct ramifications when it comes to insurance.
Absolutely.
Got it.
Yeah. So a paper trail is key. It's one thing for me to go to an underwriter. Look, my job is to effectively sell a carrier on an opportunity, right? Now, obviously, I have to be honest and disclose everything there. So if you can give me something tangible, that says, oh, they actually have rules that have teeth, they actually have consequences if the rules aren't followed, that's huge. I mean, at a very basic level, that tells an underwriter that this place is well managed. People actually are looking out for their neighbors, looking out for their community. Oh, this is a good risk. We're willing to take a chance on this. Even if it might not necessarily fit into the underwriting box, I can get an underwriter to stretch on something if it looks like there's good enforceable governance in place.
Now, the caveat there is what you just mentioned at the end, which is the enforcement. Because it's not just adding the strict verbiage within the rules. The board of directors and the community association in general needs to make sure that they're enforcing that.
That's the fun part.
Yeah, that's the fun part. Because you put in, we can't have grills on decks, for instance.
Yep.
That's in the rules and regulations. However, it's not being enforced.
Yeah.
Unfortunately, there's a claim that occurs.
Yep.
Then you're basically
you're
creating that same paper trail ends up working negatively.
Correct.
Towards you.
Correct. Yeah. Yeah. So enforcement is key. So this actually brings me to a whole other point. But what we're seeing, again, as a result of the market conditions of the past few years, carriers are doing more inspections than ever. So loss control inspections are nothing new. That's been
I was going
happening.
to ask you about that.
Yeah.
When it comes to grills and when it comes to salting.
Have you guys seen it a lot more on properties?
Well, I have,
Yeah.
but I'm just curious. The enforcement was a question of mine that I had for you.
Yeah. So loss control, and just to kind of define that, basically carriers want to inspect their investment. They want to make sure their investment is in working order. The investment being the property that they're insuring. At the end of the day, if a condo building burns down, that's on them to cut a check. So they have a vested interest in making sure that their property, not their property, but you know what I mean, their asset is protected. So carriers, standard carriers in particular, have always had loss control, but enforcement and annual inspections have been a little bit, lax or not always enforced, which was fine. The market was in a different place, but however, that's strict. That's become much more strict. So they're doing it pretty much every year now. And they come out during, the first 30 days of the policy term, and they'll come out to an inspection, and they'll send you a list of recommendations. And when I say recommendations, those aren't recommendations. That means you do it or.
Well, that's what I was going to say is it feels like, and correct me if I'm wrong, but the reason that they're probably doing this is to essentially have an out if they need one with their insured property.
Yeah.
Hey, I did see a grill that's within 10 feet, and what do they do? Drop you?
They could, yeah.
Or they just send you a reminder that just paper trail that just says, hey, if this isn't done, we will drop you.
Yeah, so what's going to happen is they're going to do the inspection. They're going to send you that list of, 3-4 recommendations. Look, 9 times out of 10, the recommendations are really basic. I mean, I had one the other day. It said, hey, there were, cardboard boxes storing stuff stacked next to a fire extinguisher. Okay, no big deal. Someone goes down there and shifts them to the other side of the room. Not a big deal. But grills are the sticking point, and there's other ones too. But so what's going to happen? They're going to give you the recommendations. They're going to say, okay, we'll give you 30 to 60 days to respond with your action plan. And it doesn't have to be anything formal. It's just a few sentences saying what's going to be done, or what vendor was hired to come out, if it's something structural, or if there's like a piece of siding that might be deficient or hanging off the building, have a contractor come up and tack it back up or put in a new piece of siding. So you're going to want to have documented proof that you address the concerns or address the underwriting matter. And sometimes they will give you bigger recommendations, major things that have to be done. And they might, more than likely, they'll give you an extension. But what they're going to do is they're going to follow up before the next renewal to see where things are at and if you actually took action on it to make sure it's done. And if you haven't complied with loss control, there is a above average chance that they could non-renew you unless you're actually showing that you're taking material steps to address it.
If that were to happen, they get non-renewed because of grills or whatever else.
Yeah.
How much more difficult is it for them to find coverage with somebody else if they get dropped?
That's a really good question. And it's much, much more difficult. Reason being, any other carrier that's looking at, that we're shopping into, we're looking at writing it, we have to disclose that they were non-renewed, but not just that, they're going to ask why they were non-renewed. And if I go to a carrier or an underwriter and say, hey, they were non-renewed because they weren't playing ball with what the carrier wanted to do, do you think they're going to write it? No.
Is that where your massive premium will come into play, I'd assume?
Because the question I get a lot is, and I think we talked about this last time, it was, will I even be able to get insurance? You'll be able to get insurance, but, what are we going to be looking at here?
You could potentially have 1 or 2 bad apples in the community that's going to wreck it for everybody, and that goes with any category. It's not just insurance.
Oh yeah.
But the point is, if you have this grill rule or salt or whatever your, the big sticking points for these carriers are, and it's not followed, and it's dropped, you're going to be penalizing the rest of your association from an insurance premium increase standpoint, because you have to go find somebody else because you wouldn't pay attention to the rules. So if you are a board member listening to this, it's really important that you have compliance. And as a homeowner, it's really important that you, put your sword down and just move your grill away when you want to have a barbecue or something, and don't be hard-headed about it, because you could really put your community financially in a really tough spot, and from a liability point as well when it comes to non-renewal or like having to pay an excess premium just to get renewed because you got dropped. So as a board member, / manager, compliance, as a homeowner, put down your torch and pitchfork and just
play ball.
Just be, okay with what's the standard now.
Yeah, it really is the standard. That's it. It is absolutely. It is the standard now. I've lived through that scenario before. It was a little different. It wasn't one homeowner. It was an actual board that was resistant to it, and they did get non-renewed. We were able to find a carrier and place it, but their premiums, I can't remember the number, but it went up exponentially. But darn it, they were able to grill.
Sure.
Actually, no, I take that back. The new carrier had the same rule in place. So it's not unique to any one carrier. So they had the same rule in place. They just had the same problem with a much higher premium.
So those are items, obviously, that are more on the risk side of things. You had mentioned preventative maintenance and making sure that you have a preventative maintenance plan. Now, terms-wise, we've talked about on this video just the importance of a reserve study, right? And just as a reminder, that's capital improvements, that's future projects. Those are the big scale, items that you're looking to replace using your reserve funds, right? And the reserve study obviously plays a critical piece because people don't know if they're truly on financial track or not, right? It feels very subjective. I always say to a board, if you have a reserve study in hand, that can be a really useful tool to kind of lower the tension potentially at a board meeting where homeowners are upset that the board is considering a dues increase, but if they have a third party, experts that specialize in kind of determining what's down the pipeline, how much money do we need to have to potentially or try to avoid a special assessment, that reserve study can take the pressure off, rather than feeling like it's
they'd be the bad guy.
Right, exactly. So that, it's not an unpopular, uneducated decision from the board. Little beknownst to maybe some homeowners, those board members are paying that same increased dues amount, but that's beside the point. But a preventative maintenance plan, Trey, is also key. Glad that you mentioned it. That's more on the operating side, right? That's to make sure that not only are you paying your day-to-day, expenses, your regular vendors, but that you're also accounting for, getting the longest life out of certain aspects that the association is responsible for. And so that plan is that's itemizing, certain aspects. Are we doing tuck pointing? Are we sealing windows? Are we, are we getting seal coating on our hardscapes? What else would be preventative maintenance?
I'll give you. I didn't mean to jump in. Yeah, well, I'll give you a perfect example. I actually did a LinkedIn post today on this true story. One of my associations, they had several little water intrusion claims. Like $3,000, $3,500 little water intrusion deals. Nothing catastrophic. However, and I can talk about this, it's a whole other issue, but underwriters are not just looking at the big losses. In fact, a lot of times those are shock losses. We can talk an underwriter through that, get them past that. What they're really concerned about are patterns. If you're starting to see, 4 or 5 small water claims over 5 years, that's gonna put their antenna up. This is a recurring issue. So an association that I work with, at the end of last year, they had a big meeting and agreed to, okay, we're going to put all new flashing in around all the windows in the entire association. Guess what? No more water claims, just like that. And this year on the renewal, we saw their premium go down because we were able to get them from a surplus lines carrier into a standard market. So, and flashing is not a huge job. It was not a bank breaker. It wasn't, a full roofing job or anything like that. So that's a case in point example of how preventative maintenance can take you from, this bucket with a, really, really high insurance premium to this bucket with a much more reasonable premium.
Interesting. And so those trends from a maintenance side, perhaps some board members don't, they may take the approach of, well, the builder that built our community must have done a pretty decent job, and we're just going to be planning for the next large scale replacement.
Yeah.
Really missing the fact that routine maintenance is key and has insurance implications.
Yep. I was out doing, we're doing fall cleaning around my house, and my wife had me out. Our house was built in 2019. It's not an old house, but you get out there and you look at it, things start to break down. The weather takes its toll. So I was out doing little things, just shoring it up this weekend. So yeah, preventative maintenance, critical. And again, not all preventative maintenance are big bank breaker projects. You don't need to go take out a loan for some of these smaller projects. So it's very doable as long as you have a strategic plan.
And we've talked about communities. Sorry, Mitch.
No, go ahead.
We've talked about communities being, at least statistically being underfunded, right? But it's not just to say that, we're suggesting an increase, or the board suggesting an increase, just, willy nilly. There's key things that need to be funded, reserves, operating, and then making sure that you have enough money for insurance and the changes and the fluctuation of what insurance can be.
Yeah. I recognize how challenging that can be in a board setting too. You're always going to get resistance to it, and that's I've sat on my own association's board before, so I'm practicing what I preach, so I understand how difficult that is. But yeah, it really, and again, I go back to a lot of this stuff. There's crossover. It's not just for insurance. You're taking care of your property. It's just pride of ownership stuff. So yeah, I think you made a lot of really good points there. That's critical stuff.
You cover so much. There's so much to talk about here. I kind of am curious on your message to homeowners, and then your message to your board member clients as well. Like, if you could speak to each category of the person that lives in an HOA, what are the couple things you would say to homeowners and to board members on the kind of the experience that they've had? And everyone kind of probably has a poor taste of insurance in their mouth over the last 1 to 2 years.
Yeah.
And what do you have to say to the homeowners that think that, and then also board members?
Yeah, I can speak from a place of authority on that, just because I have those conversations every day. I speak to the angry homeowners literally every day, and I speak to the board members every day too. So to the homeowners, the general sentiment I get is just exasperation, frustration, and I completely sympathize with them on that. I get it. What they don't often have is kind of that 30,000 foot view that I have, kind of working in this every day, to see kind of how we got here. And there are real reasons why the market got to where it was at. We don't need to go into all that today. I think we covered that in our last video. But, my biggest message to a homeowner would be, your board is effectively hamstrung by a really challenging insurance market right now. But there is light at the end of the tunnel. Have grace with the board. They're working with the best resources they got. I'm working with, as your agent, and working with, everyone has limited resources in a hard market. There just aren't as many carriers. I'm working with limited resources.
And to the homeowner, there are certain things, like you mentioned earlier, that a board can do to help.
Yes.
But it's not their fault on why the insurance has increased so much over the last 2 years.
Correct.
I want to be clear about that, because it's not like it's the board member's problem. It's like they didn't cause this.
They didn't drop the ball anywhere.
But they can take good proactive steps to help combat potential insurance premium increases and stuff like that.
Correct. Absolutely. So I hear it all the time. I'm a big boy. I get yelled at saying, I have homeowners call me and say, you're screwing us, the insurance company, you're jacking our rates up.
Yeah, must be nice, that giant commission that you're getting.
Yeah.
What time did your private plane land today?
Oh man, you got jokes. No comment. But no, the board cannot. They have effectively been left with very little leverage. If you live in a 50-year-old property, you can't change the age of that property.
Mhm.
Okay. And over the past 5 years, carriers almost universally said, we're not writing anything over, 25, 30 years old. That's not the board's fault.
Right.
There's certain characteristics about your property you just can't change. As the market shifts, and I tell this to homeowners all the time, we are starting to see, patterns that are encouraging that yes, you are going to have options, more favorable options as an older property soon. Now, I'm not making promises I can't keep. It's not necessarily going to happen overnight, but we are seeing positive signs. Generally, homeowners, once I kind of explain the context of where we were, how we got there, where we're going, the conversation is much more amicable and, cooler heads prevail. They generally get it. So I would tell homeowners, be engaged. That doesn't mean, barking at your board and telling them that, you're screwing us here, because that's not the case. They're doing the best they possibly can. To board members, I would reiterate kind of the beginning of this conversation we have. I'm actually having these conversations almost daily with board members, just kind of giving them a market update. I personally like to, throughout the year, touch base with either my property managers or board members and just say, if there's a big shift, say, hey, here's where things are going. Like once a quarter, just check in and say, hey, here's a quick market update. What's happening? Now, those market updates have been nothing but bad news for the last few years. This is the first time we've been able to say, hey, look, I think, last year you budgeted for a 50% increase. I think we might be able to tick that down a little bit this year. So there absolutely is light at the end of the tunnel. If you follow some of the steps we've laid out earlier in this video, preventative maintenance, reserve studies, taking care of things that need to be taken care of, roofs, wiring, HVAC.
The hard part about this whole conversation, because I can hear, if you want to play the devil's advocate on both a
Yep.
homeowner and a board,
Yep.
is all of it requires cash, right?
Yep.
All of it requires cash. And so I can hear the homeowner that has the attitude or posture of, well, yeah, we'd love to do preventative maintenance if we didn't have to pay 100% premium increase.
Yeah,
And
fair.
we could do all those
Fair.
things,
Yep.
And so I get that they would be frustrated and say like, oh yeah, we'd love to do that.
Yep.
But we can't afford it because we're paying for all this insurance. Now,
Yep.
with that being somewhat stabilized or reversed, like you've said,
Yep.
I could also then highly recommend board members, if you're seeing a decrease in your insurance premium, don't lower your dues as bad as you want to.
Yeah. Yes.
Use
yes.
that money to then do these things, these
Yep.
preventative maintenance specifically,
Yep.
but don't lower your dues, because then you'll put your community, you'll hamstring your community
Yep.
into a bad spot where you're going to have to do a special assessment for an insurance premium or
Yep.
something at some point in time.
Yeah. The insurance market could shift again.
Right.
So, don't fool me twice. All right. So go ahead and build some of that cushion in now and save it for a rainy day. I think using it for preventative maintenance plans or having a reserve study done.
Like you are where you are now, right?
Yes.
So don't go backwards if you're a community that's like, okay, well, we don't have to budget for the X amount of increase.
Correct.
Maybe we can adjust our dues down. From what I've seen in my experience, I would absolutely recommend against that. I'm sure all of you guys would agree.
Yes. But yeah, I think that's really good advice. Do not, overnight just say, oh, our premiums are stabilizing, we're going to drop rates by 20, 30%. No, do not do that. That is money well spent towards your future, towards protecting your property, and potentially towards another market downturn. So build it in now.
At HOA Assist, we provide financials for clients across the country. You also can write policies
Absolutely.
for, is it any state?
Yeah. Alaska and Hawaii are goofy, but I don't get a whole lot of leads from Alaska and Hawaii. So
Okay.
if you see me in Alaska and Hawaii, we can
Yeah.
make it happen. Call me. But everywhere else, the continental U.S. is we can write nationwide. I'm working on one in Texas right now, and one in Utah right now. So we have a pretty big footprint.
So board members, reach out to Trey if you want just someone who, is prompt in communication. I know that our clients certainly appreciate that about
Thank
you,
you.
but also just your knowledge of the industry and that it isn't just isolated to one part of the country. You have a pulse really on what's going on nationwide.
Thank
Yeah,
you.
I mean, we've worked with hundreds and hundreds of board members. We have a decent amount of associations we work with. I think we have yet to have any sort of negative feedback about anyone that's ever worked with Trey. So if you're a board
Appreciate
member, it's in your best interest to contact him. And I wanted to chat about this with you because I've seen a lot of this on your LinkedIn
Yeah.
lately is they can obviously contact you however they want, but why don't you share with the boards what you're doing, how they can get a hold of you, what you're
Yes.
doing on LinkedIn, how that can benefit them.
Yep.
Because there's a lot of really good content.
Yeah, thanks. That's, and I appreciate the kind words, guys. Thank you. LinkedIn is kind of my primary method of communication. So obviously email, phone number, we can put all that in the video, but best way to reach me, give me a follow on LinkedIn, reach out, message me on LinkedIn. So if you go to my page, you'll see that, my goal is to kind of shift the paradigm on HOA insurance. Like it's a niche topic. And there are tons of insurance agents out there, not a ton of insurance agents who specialize in this space. And there's a big difference between the two. So my goal is to put out just relevant, non-salesy content on my LinkedIn page to just give real world examples of how boards and property managers can best position themselves for effective renewals, how to position themselves in a tough market, how to manage claims, how to avoid insurance pitfalls. And not to pump my own stuff up, but I do think there is some valuable content in there, and it's free. It's a free resource, so go take a look.
Well, I think your attitude about this whole thing, or posture about how you're approaching this, is similar to our attitude of it is to just be helpful.
Yes.
If you are helpful in the eyes of someone that stumbles onto you,
Yep.
That could go a really long way. And so I think what you're doing on LinkedIn is really cool.
Appreciate that.
Because it's really helpful for those that are in the HOA space on a board looking for insurance. Maybe you're even a manager that, you need resources on how to help direct your boards or whatever it is. You'll probably find some content on there from Trey.
Yeah.
One thing that before we end it, is another topic that was a really hot topic the last time we chatted was about loss assessment coverage.
Oh yeah.
And so I do want to touch on that too, because that's, I believe, probably still just as important as it always has been.
Yep.
Is there anything different about loss assessment coverage? If those that don't know what loss assessment coverage is, tell them what that is.
Yeah. So I've talked, actually, speaking of LinkedIn, I've posted on this a few times just because it's one of those really, really critical elements. So I wouldn't say much has changed. However, it's just as important, if not more important, than it ever has been before. So for those of you that don't know, so loss assessment coverage is the coverage, that homeowners can purchase on their individual HO6 insurance policy. An HO6 policy is just fancy lingo for a homeowner's policy for a condo or a townhome unit. So it's specifically designed for multifamily dwellings. Loss assessment is a really unique line of coverage that is typically included on every HO6 policy, that is designed to cover master policy related assessments that the board hands down. So as I mentioned before, premiums might be stabilizing, but the terms are here to stay. That's going to include things like high wind hail deductibles, like 5% wind hail deductibles. In the event of a large wind hail storm, a 5% wind hail deductible could mean millions of dollars in deductible cost. That's just deductible cost to the association. Mm-hmm. And what a lot of folks don't realize is that the board, it's within their authority to assess that cost to the homeowners. Well, that's why loss assessment coverage is built into these HO6 policies. It's designed to specifically pick up that exposure. So if you're assessed as a result of an insurance-related assessment, then that coverage will come into play. So it's
usually really cheap, right?
It's usually very, very cheap.
I mean, we're talking cover you up to.
So typically, most carriers max out around $50,000. We do have some carriers with our agency that will go up to $100,000, which is even better. But it's important to note that while most HO6 policies include at least some baseline level of coverage, it's usually only like $2,500 to $5,000 that's automatically included. So you need to actually ask your agent to increase that. I would say automatically go to $50,000. It's too cheap not to carry.
What would that $50,000 loss assessment coverage look like as far as out of cost to the homeowner?
Yeah,
roughly.
Yeah, $30 to $40 a year, maybe.
A year.
Yeah. I mean, it's
a cup of coffee a month.
100%. And what I tell my clients is this coverage is
for $50,000.
Yes, I would say tell your agent max that coverage out, whatever their limit is. It's probably $50,000. Max it out. It might cost you $30-$40 a year. And all it's going to cost you, if you're ever assessed, is going to be your deductible. So like if you have a $500 deductible, that's the only piece you pay.
So a simplified explanation of how this could actually play out,
Yep.
Trey. Let's use the concept of a roof needs to get replaced,
Yep.
right? You live in a townhome or a condo, obviously the roof is it's association expense. Roofs, especially in a, townhome community, they're not sectioned off.
Yep.
It's all considered essentially one roof, right?
Yep.
And so play that out with numbers based
Yeah.
on a roof getting replaced.
Yeah. So let's try to use some round numbers here. Let's just say,
I have my phone. I can do that.
okay, let's just say, just for the sake of using round numbers, a property, 10 buildings, each building carries $1 million insurance limit. So it's a $10 million property. That property carries, okay, hailstorm comes through, damages every single building. Every single building gets a covered roof through the insurance policy. Well, that means
And it's a 5%.
it's a 5% wind hail deductible.
So you take the 10 million times 5%.
Times 5%, what are you going to get?
$500,000.
$500,000, yes. So $500,000 is the deductible cost to the association before coverage even kicks in. So, well, it'll pay out and then they'll deduct that from it. That's a whole other conversation. But effectively, the association owes $500,000. The association, the board, then decides to assess that to the homeowners. So I didn't do the unit count. Let's say there's 4 units per building, 4 times, so that means 40 units. So you would just do $500,000 divided by 40 units.
$12,500.
$12,500. So that means every unit owner is going to get a letter in the mail saying that they owe $12,500 to cover this assessment. If you carry loss assessment coverage, you turn that into your carrier, they cut you a check. And they cover the assessment for you, less your $500, $1,000 deductible. So again, and that coverage might cost you $30 to $40 a year. But every time we see a claim without fail, we end up seeing people that just don't have the coverage. Now, if that's their fault or their agent's fault, I don't know. But like I say, it's just too cheap not to cover.
And if they don't have that loss assessment coverage, Trey, then they're out of pocket for that entire $12,500.
100%.
Right?
100%.
And so that minimal monthly cost for that loss assessment coverage could essentially save them, $11,000 or $11,500.
Absolutely. So, outside of your basic dwelling coverage on your home, I would argue that loss assessment coverage for an association, member is probably your most important line item because we see this coverage triggered all the time, especially in hail-prone areas. So, critically important.
Trey, thanks for coming. Wealth of knowledge, wealth of information. Hopefully it's super helpful to the people that'll listen to this particular podcast or episode. And again, contact Trey if you have questions. Really appreciate you coming in on your private plane today in, seat 28C.
Right. That's more like it. Yeah.
But no, thanks for coming in. It's really awesome to have you always. And, he'll be back. But if you have questions for Trey, give him a shout. Trey, how can they contact you?
Yeah, thanks guys for having me in. Always a pleasure. You guys are doing a lot of really, really cool things in this space. It's been fun to watch your company just grow over leaps and bounds. And just dealing with your clients on the insurance side, I hear nothing but good things. So you guys are killing it, which is awesome. I would go back to LinkedIn is a great spot if you wanted just some free educational content. None of it's trying to sell you on something. Just take a look at it. I think there's a lot of educational stuff I put out there that will be of value. Feel free to direct message me on there on LinkedIn, or you can reach me at my direct dial, which is 952-746-4302, or my email address, tgriffy@nesbitagencies.com. So I hope to hear from some of you. It's been a lot of fun, guys. Thanks for having me.
Thanks.
Yeah. Thanks, dude. Safe travels home.
Thank you.